Recession. Educate yourself to make more money. Welcome back to our YouTube channel Shareholdr. In today's video, we are going to talk about the recession and ways to take advantage of a recession. The Great Recession ended in 2009 and impacted the lives of many. Now that the economy looks headed for another recession, it's a good time to review how to take advantage of the recession instead of letting it take advantage of you. There are many lessons for investors to learn, many of whom have seen their investment accounts devastated by panic sales. If they kept their investments, they would fully recover and increase in value. This is the first lesson of any recession. A recession is always followed by a recovery that includes strong market rally. The second lesson is that investors don't have to stand by while their portfolios are hit by the sell-off. There are some investment strategies that can harness the focus of the recession to position a portfolio for a quick and strong rebound. Use the dollar cost when doing share prices decline. As with most recessions, you probably won't see the next one coming, but chances are you'll see a sell-off in the stock market long before a recession. When that happens, remember the first lesson: there is a recovery after a recession. Knowing this, investors can take advantage of a declining market through the dollar cost averaging method of investment. If you make money contributions to a qualified retirement plan, you are already using this technique. But when the market starts to swell, it's time to take advantage by increasing your contributions or starting the average dollar cost in an unqualified investment amount. When you average the dollar cost of your investment, you gradually reduce the overall cost base in the stock price, so when the price recovers, the cost base is always lower than the price. For example, if you invest $500 a month into a mutual fund that sells for $25, your contribution buys 20 shares. If the share price drops to 20, your contribution buys 25 shares. Your account now has 45 shares with an average base cost of 22. As the stock price falls, your $500 contribution buys an increasing number of shares and your cost base continues to decline. As stock prices rise, your contribution buys fewer shares each month, but the current share price is always above your cost base. The dollar cost averaging method works best in the long run for investors who don't want to worry about the performance of their investments. If you plan on holding stocks during a recession, the best to own are those of large cap consolidated companies with solid balance sheets and cash flows. Buy into dividends. If you plan on holding stock during a recession, the best to own are those of large cap consolidated companies with solid balance sheets and cap flows. These companies are not only better placed to withstand economic downturns than smaller companies with low cash flow, they are also more likely to pay dividends. For investors, dividends serve a few purposes. First, if a company has a long history of paying dividends and raising dividends, you can rest assured that it has a financially sound and can survive most economic environments. Second, dividends provide a yield buffer. Even if stock prices fall, you'll still receive a return on your investment. It is for these reasons that dividend stocks tend to outperform non-dividend stocks during market downturns. The best way to own dividend-paying stocks is through mutual funds or exchange-traded funds that invest strictly in dividend-paying companies. Funds that invest in companies with a long history of dividend payments and a solid track record of raising such dividends tend to generate higher current returns with capital appreciation. However, don't expect these funds to outperform the market during market bounces. They are held in portfolios to provide stable returns over different market cycles. As the market recovers, you can gradually allocate your dividend funds, but you should always keep a portion of it as a defensive measure. Dividend adjusted close or adjusted close price takes into account distribution of corporate transactions that occurred between the previous day's closing price and the next day's opening price. Dividends reduce the value of a stock because earnings are distributed to shareholders instead of being reinvested in the company. Number 3. Invest in customer staples. Even during recessions, consumers are purchasing food, medicine, hygiene products, and medical supplies. These are basic necessities that are the last items to be cut from the family budget. So while companies that sell flat-screen TVs and other discretionary products experience a decline in revenue, companies that sell food and other basic necessities do not. For this reason, consumer staples companies are sometimes called defensive stocks, as they remain resilient even when the economy falters. The data shows that this type of company has outperformed the S&P 500 over the 5 periods of recession. Consumer staple companies include Johnson & Johnson, Procter & Gamble, Conagra, and Walmart. These companies also in particular pay good dividends, which reinforces their defensive profile. There are also mutual funds that invest strictly in staple businesses. Fidelity Select's essential goods portfolio invests at least 80% of its assets in companies engaged with the production, sale, or distribution of essential goods. mutual funds that track specific sectors. Investing in funds such as exchange trading funds or low-cost index funds is typically less risky than raising and investing in individual stocks, which can be particularly attractive during a recession. Investing in funds gives you exposure to specific stock baskets, rather than a single investment like a single stock. In times of recession, there is a way to invest in multiple companies in the most resilient sectors and avoid concentrating risk in one company. If a fund company has a negative performance, the strong performance of other companies can offset the losses of the company with the worst performance. For example, if you only want to invest in consumer staples companies, you may want to consider shares in the Vanguard Consumer Staples ETF or the Consumer Staples Select Sectors SPDR fund. These lows emerged from the bearish Great Recession. The market was down 29% and 27% respectively, while the S&P 500 was still down by more than 50%. Both funds include holdings like Procter & Gamble, Coca-Cola, Pepsi, Costco, and a host of other consumer staples companies. Most people don't pick stocks, Fernandez says. Most people will be better off buying an index of something and letting that index serve its purpose. Healthy companies overall. If you are interested in investing in individual stocks during a recession, you can look into some healthcare sectors. But this is not the only criteria. Low debt, profitability, solid balance sheets, and positive cash flow can help a company overturn times in economic crisis. So how do these companies identify themselves? One of the best places to start is to use a free stock filter. If you already have a brokerage account, it will most likely be available on the broker's website. Here are some example criteria to set in the action filter. Set the market cap to large cap or higher. Large cap stocks are stocks of some of the largest US companies, technically with valuations of 10 billion or more. These companies tend to be more stable during volatility and have a lower risk of failing. Set the price trend. This is how you will find individual stocks that have outperformed the market as a whole. First, you will need to determine the performance of a large market index, such as the S&P 500, over a specific period. To find the best performing stocks this year, set the price performance filter in your stock appraiser to show something above the performance of last year's S&P 500. Choose common stock. If you have the opportunity to filter by security type, select common actions to make things easier. You can also choose to filter stocks with positive dividend growth. Rising dividends can be a sign of financial strength and discipline, healthy balance sheets, and steady cash flow, all of which can help companies overcome recessions. Keep in mind that this filter will limit your choices to dividend stocks only, but it should include some of the more established companies that can better withstand tough market conditions. This does not mean that these companies will always be strong in a recession. Always keep in mind that past performance is no guarantee of future results, but these are the data points that could help inform your eventual choices. Tell us in the comment section your view on this topic. That's all for today's video. If you liked watching our content, consider subscribing to our channel by clicking the subscribe button below. Thanks for watching.